Hello traders and welcome back for another daily episode of Bitcoin Technical Analysis with me, your friend Rocky Outcrop. In today's episode we'll be checking out the price action over the weekend where we saw the prices go up some, and we'll be asking whether or not the prices will continue to go up this week or if we could have some more downside in store over the coming days. Okay, let's just dive on into the charts and take a closer look. Hi, so welcome back. Thanks for sticking through the intro credits. Now, you might see some writing on the screen behind me, but I'll just introduce the chart first before we take a look at that little poem that's there. That's almost a poem. Didn't mean it. I'm a poet, but I didn't know it. Anyway, we're looking at the Bitcoin versus US dollar chart, and this is the 24-hour chart. That's the daily chart, and the information comes from Bitstamp, and this is, of course, is TradingView. Okay, and you can see down here in the bottom right the range for the day so far has been 8,546 as the low and 8,677 as the high. That's represented here in this daily candle right here, which is not a very big one when you compare it to yesterday's. And wow, yesterday's candle was all the way from 8,319 up to 8,587, and certainly is a bullish engulfing candle and much more positive than what we've seen over the previous week. So what is this little sort of poem thing? See, I genuinely didn't mean to be writing like a poem there. It just worked out that way. Will we see a higher low here, now, or after? We've seen an end to the downward trend. Well, it's not really much. It's a rubbish poem. Okay, but why have I written? Why am I pointing that out like that there? And why is the arrow pointing here? Well, I just wanted to draw our eyes to. Let's get rid of that arrow now. Just wanted to draw our eyes over to this idea that if this sort of is a downward trend over the last several days, then what we'd be looking for here, just as a starting point really, in terms of the real bare bones technical analysis, would be for the prices to come up above the 8,660 or so level and maintain there, and to be able to turn around this downward pressure and change it into an upward slope again. Okay, and that's basically what we're looking at there in a really sort of simplistic level, but that's a really good solid starting point. Now, I'll just get rid of this and I'll go over to the CMEs, the coronal mass injections, and that show you what inspired it. So, right here, you can see on the coronal mass ejection chart, that's the CME, Chicago Mercantile Exchange, that there is a 35 buck gap. Okay, so the question becomes, you can see it here when I stretch it right out, and I'll just point out the levels to you now. So there is a gap on the CMEs, and that's 8,540 where this wick came to, and then where we started at 8,575. So there's a $35 gap right in this area here. And the question is, will this gap be filled before we keep going up, or will we be able to go up some and then expect to come down afterwards? And should we keep this penciled in our diaries as somewhere that the prices might revisit? Well, the daily gap charts the gaps on the daily chart on the CMEs normally do get filled, and that's why I call it Chicago Mercantile Exchange the coronal mass ejections, because when there's a gap on those charts, it can send it's like a coronal mass ejection in that it can wreak havoc with people's computer systems worldwide. So I'm just getting rid of this as well. Sorry, just to get it off the chart. It's a bit noisy, but I think it draws the point out. Now, can we expect to see this here possibly get filled? Well, it's an interesting idea, and it is certainly a possibility. So I would have that in mind over the next wee while. Certainly, if I had been caught in a short previously to this, say I was shorting it around this area, and I was worried about whether or not I would get out, well, that would offer me some sort of solace in the meantime that there's some sort of downward pressure there. Over the weekend, we were looking at whether there could be a gap in the charts below here, and it didn't look likely at all. And that would have maybe given us some upward pressure. If the gap in the chart was above where the spot price currently is, that may have helped put some pressure on it to bring it up a bit, and that would have been good news for people looking to see this downward trend end. Now, the inverse of that is also certainly true. That I just go back over the purpose of the CMEs has been filled. This downward trend here over the last week or two has been um, that if the gap had been, the gap is now here below where the spot price is. So if you're looking for this downward trend to continue, then seeing a gap here below the current spot price is beneficial to you if that's what you're hoping for. Now, how do I think that that affects the overall macro? Well, over the last while, what we've been looking at really is this upward movement after the head and shoulders, inverse head and shoulders here. It's not clear on the chart at the minute, but you can take my word for it. And then there's this upward movement there. Now you can see the head and shoulders there a bit better. So this fulfilled that measured move that you would get from the head and shoulders, and we came up and we tested off of the initial profit taking zone on a macro Fibonacci retracement drawn from June 28, 2019 to December the 16th or so last year. And that is the overall downward trend that we've been in. If you remember, for the last 6 months of last year, really the prices just seem to go down and keep on going down. So this is where we retraced up to, and that's a normal profit taking zone. Of course, the 200 simple there is also another signal to people to take profits at that area, because it offers up a lot of resistance and indeed support. Once it's crossed over and we establish ourselves above it, then that would offer us support. So then we saw that the prices came to here, and we thought, well, quite normal, what normal price activity in the market is for on the daily chart to come back down and visit the 21 again, and potentially even the 200, since they were so close to each other. And that also lined up with this straight horizontal line here, this one, which is the 236 of that Fibonacci retracement. Now, the 236 isn't a profit taking zone or anything, but it's certainly significant in terms of Fibonacci retracements, because if you never make it to there, then you're not really using a Fibonacci tool correctly at all. So as soon as we actually made it above this area here, where we consolidated at around 8,200, and then we broke through it, that was significant, because that means that this Fibonacci retracement from June actually comes into play and could even be actionable in terms of how we manage our trades. Okay, so that's the current sort of situation. We came down, and then a lot of people in the world, we predicted after this rise up that there would be a great deal of bearish sentiment entering into the market with all of the FOMO analysts out there. So the FOMO analysts will have been saying, no doubt, I've not been catching up with them, but no doubt the FOMO analysts have been saying that that the prices will be doomed, and that they'll have drawn a retracement from the bottom here to the top here, and said that we'll retrace down to around the 7,500 level or so as part of a Fibonacci retracement off of this move. Now, I wasn't very keen on that idea, because then I kind of start to wonder why you'd bother even with the Fibonacci retracement at that point, because there's so many other confluencing factors on the way down that you could almost just that it isn't particularly useful for your technical analysis really overall. When you look at things like these moving averages, the neckline from the head and shoulders move, and Fibonacci retracement, and everything else that you've got on the way down there. And of course, we're talking at that stage, we're talking $1,000 move away. There's certainly plenty of benchmarks to go past on the way, checkpoints to go past on the way, where you could be great for taking trades and managing risk and taking profits. So really, that's what we've been looking at. And the question then was, well, this is all totally natural in an uptrend, if this is an uptrend that we've begun here, to come down and set in a higher low. And so far, we've been successful in doing that. And the positive candle we saw yesterday was great boon for people who are looking for us to have set in a higher low and go on up. Now, obviously, the big caveat to that is the CME gap, which I pointed out at the start of the video, which is really essentially the main thrust of this video today. Now, from over here, where we had a high on the daily chart, to over here, where we have a high on the daily chart, there is bearish divergence between those 2 points. And at some point in the future, if this doesn't ever really play out more so than it has done here so far, for instance, then, which indeed it could do, and we could look back in the fullness of time and say, well, that was that playing out. But if it were to play out just as much as this and then go on, at some point in the future, that will just become an artifice of the past. It will just become an historical artifact, which is on our charts, sure, but at some point in the future, we'll be able to relinquish that from our psyche and release it. And what I'm really looking to see happening on that front is for the and I've just moved it off screen so that we can not be distracted as I make the little point here. Is I'm looking for this to come up here and start to shake off any bearish divergence that there might be on the daily chart by achieving the RSI and the other stochastic, the stochastic and the MACD indeed as well, to come up here and to go up here and come up a little bit higher on the RSI and shake away any bearish divergence that we might have had. And that would be good to coincide around some crucial level of support and resistance so that we can get a jump up and beyond, and then we would be able to have a natural retracement and readjustment, amelioration, amortization in the markets up at a higher level, so that things could then, the oscillators could reset down below without having to actually continue the macro downward trend, which is the crux of their technical analysis for, say, January to February, say our technical analysis looking towards Valentine's Day. That's essentially what we'll be looking at overall. Okay, and I think that more or less wraps up the video, but before tuning out, I will just check through the lower time frames and see how we're doing in terms of divergences, because that was certainly something that was helpful to us yesterday. As we pointed out, if you hadn't necessarily seen it yourself or didn't tune in yesterday or on Saturday, indeed, you could have quite easily have seen this MACD was showing us bullish divergence, Class A bullish divergence on the MACD very clearly, and indeed it's here visible on other ones too, but the MACD makes it strikingly obvious. So on this downward trend here, we could have expected to have potentially had an upthrust afterwards. At least at least if you want to talk about it from a risk management point of view, which is always more sensible, it would have been wise to have been taking profits on shorts in and around this area rather than to try and see how that bullish divergence would play out. It was a warning sign for those, or indeed a call to dinner for longing Pavlovian dogs out there. So that's that. And what are we looking at currently? Well, it is quite hard to tell. Oops, sorry. It is quite hard to tell if what sort of we're at now, because we haven't got enough here to say that we're trending really in either direction, but we have gone up here and we've got a high, so that's good. But we haven't set in another higher low or higher high at all to sort of check and see if there's divergences here. So I just wanted to point that out. That's kind of where we are in the 4 hour for today. On the 12 hours, we can see that the stochastics is pointing up with gusto there. That's nice. RSI has gone up above the moving average, which is good because it hasn't been there since the 18th of Jan. And we're above the neutral zone, the neutral line here, which of course you may notice is very close to the bearish zone. But that's part of my risk management, and that's a good thing, good healthy way to have this laid out as far as I'm concerned. So we're up into this neutral area here, moving towards the bullish zone, and between this low here and this low here, we can see stronger lows there. So could we say that is hidden bullish divergence, possibly some hidden bullish divergence if you consider this to be an overall uptrend on, say, the 12 hours. Between this point here and this point here, you can see that there was, of course, bearish divergence. And, well, as that just played out there over that period of time, it may well have. Between this point here and this point here as well, it's even clearer on the MACD. I quite often find that the MACD is easier, the histogram of the MACD is easier to see just on a purely visual standpoint because of the way that it's drawn, compared to sometimes lines and things, because the lines can be a bit thinner and can leave you sort of having to move your head closer to the screen as you zoom in to see what's going on. And of course, for the purposes of making these videos, it's much better if you don't have to closely examine my hairline. So so that brings us back to the 24 hour, and just wanted to point out that we're above the 10 simple currently. Could we see a degree of resistance here at the 10 simple for maybe a day or so as we come down to fill up CME gap and then move down past it? I feel like that would be natural. I wonder if I wouldn't want it to come down too low for sure. So it is sort of I think that would only be a brief time if they were to come down there, because I wouldn't want to see this actually setting in lows again and just merely be part of this movement upwards. You know what I mean? I'm talking about like how you can have wicks here and stuff, and how if it were to come down here and close down here, then you'd be talking about sort of continuation. Whereas if you get a wick down and up again, then sure, that's not continuation, that's just healthy. So we were already on the 4 hour, and I can just check out things like the 1 hour, see if we see anything on here jumping out at us. Particularly, could there be some sort of pattern here? I don't like looking at patterns on, is that some sort of Quasimodo thing? No, I don't like looking at patterns on the 1 hour. I'm not going to invest much time in it today, certainly anyway. But what can we see here? We're moving up the way here. I'm just checking the bottoms in an uptrend because it's easier to look for hidden bullish divergence first if that's your routine, because otherwise you might forget it or be distracted by the classic divergences on the top side. So we're looking at the tops here in this current upwards thing. I'm looking for any sort of divergences, and you could potentially say that there's something going on here in terms of class B, potentially up here and around the top here on the RSI. Could have potential class A divergence here on the stochastics. Looks like that'd be bearish divergence, and indeed on the MACD between that point and that point. Yeah, so there's a little taste of that on the 1 hour. Of course, so that all chimes more or less with what we've been looking at. And for the sake of brevity in today's video, I'm just going to skip looking at the smaller time frames. They're for lunatics anyway. And well, what are we? We're lunatics too, but we're just going to we're not going to do that. We're going to skip on for that. Okay, so thank you so much for tuning in. I have to say, by the way, thank you so much to every single person who tunes into any of these videos and watches even a second of them. I'm absolutely loving this so far. It's fantastic. During the weekend, I got to that 1% benchmark. I have 12 subscribers, and now I have 43 hours of watch time on YouTube. That's so fantastic. Only need to increase that by, what is it, like 10,000%, 100,000%? I need to move, that's 1% of me towards the targets that I need to be able to sort of monetize this channel. And well, I mean, I'm not even that interested in monetizing the channel. I just think that that's a career-wise pat on the back, and that's, anyway, I just love it that there's 12 of you out there that are willing to tune into this every day. And if any of you else want to subscribe to these videos, I do make them every day, then I would really, really, really appreciate it. And thank you so much to everybody that's been tuning in so far. Just tuning out now, but what have we got here in this between this point here and this point here? This is the 2 hour. Yeah, that's not divergent there. That's not divergent there. That's so there you go. That's kind of the overall picture. There's a little taste of divergence, bearish divergence on the 1 hour. That could help with the CME gap being filled. And what's that big wick there? Hasn't been filled as I was talking about it, has it? Surely not. Well, okay. I'll check that afterwards. I don't think it has been quite yet, but there's certainly a wick there worth investigating. Okay, so thank you so much. Thank you to everybody who likes, subscribes. Thank you so much. I genuinely appreciate every single, I genuinely do. I thank you so much. Okay, so thanks for tuning in and for being a part of this community as we just get going. And who knows, in a couple of years' time we'll look back then, you OG guys, oh, it's great. Okay, catch you next time.